Hello, and welcome to the next in our series of recordings about private equity and professional services firms, including law firms. I am joined here today by my two fabulous partners, Zulon Begum and Corinne Staves, who have a huge amount of experience in advising and thinking about issues around external investment in law firms. Today, we are particularly focusing on issues around remuneration for senior talent, for partners. One day you're a partner in a law firm, drawing out a big profit share, so your monthly drawings, and then your kind of maybe quarterly distributions after that. And then the next day you are in a private equity backed firm. So what does that look like from one day to the next? Corinne, I'm going to start with you first, if I may.
Thanks, Claire. Um, let's take a step back. The really key point here about accepting external investment into a law firm, into professional services firms, is that the whole model is going to change. The whole point in this sort of new world is going to be that the organisation is striving for growth, for sort of driving that growth, for that capital value increasing. So what you're moving from is an environment where you are effectively, usually, distributing your income year on year. Almost firms have got a sort of a full income distribution every year, annually basis, to a system where actually you're driving the business to invest for the future, to drive that capital growth, so that the kind of the bumper return for you comes at some later stage when you've sort of built up that business, and then you get some kind of return on that growth, on that built up business. And so it's a complete shift in terms of the way that the businesses operate. So what's that going to mean in practice? Well, in practice, it's probably going to mean that the partners who were used to receiving a profit share, represented in cash terms by drawings during the year, and then distributions of surplus profits after the end of the year, I think what it will probably shift in most cases to is a salary or a salary equivalent, probably some kind of bonus for some kind of performance related return, and we'll come on to that more, I know, in later in this discussion. And then finally, there's going to be some interest in the business, some kind of equity in the business, whether it's shares or other type of interest, where that will represent your investment in the business, your equity, and that is where you would hopefully see your return in due course.
Then if you are an equity partner in the firm that is then changing and taking in sort of private equity backing, firstly, presumably senior management needs to be very careful that it understands what will be sort of like the day-to-day financial needs of its partners, and ensure that the drawings or drawings equivalent will at least cover that. But equally, the partners need to understand that it's not going to be an income gig anymore. It's about the long-term capital growth value, provided that that you are able to hang around for long enough to get the benefit of that. And obviously, we do see systems which are set up around good leaver and bad leaver, and they can be, the wording around that can be quite challenging and quite open as to who is and isn't a good leaver to be able to participate in the capital. I don't know if there's anything that you want to add on that point, Corinne.
Yeah, absolutely, Claire. I think that you do have that scope in some of the more modern models to be able to incentivize other people in the business. What I would say is that you don't need PE backing to have a structure that enables you to offer those incentives to different parts of the business. It's just that it is fair to generalize that we don't see that in all professional services models, and that may be a deliberate decision one way or another. I also think the point you make there about what happens when partners leave is a really important one, because the model expects that the partners stay with the business and support its growth and stay in the business for a prolonged period of time. They would then benefit, for example, from a secondary transaction, maybe a third transaction in many, many years' time, and they would expect to see a return on their investment at those points. But almost invariably, you will find that if you leave, the shares that you hold are in some way either forfeited or sold back to the business at a low or no value if you are not a good leaver. And good leaver for these purposes is usually someone who's not dead or retiring to the garden. So it is quite stringent. I mean, obviously it depends, and that might be one of the things that firms really closely look at when they when they're sort of negotiating these terms at the outset. But I think the reality is here that the value needs to sit within the business. So the scope to go elsewhere, or in some businesses, partners are even allowed to take their clients elsewhere. There won't be any scope to be able to leave and join another business and take your clients with it in that new model, because that value is considered to be the business's value and is closely protected, because it all contributes to that goodwill, to that capital value, which is the name of the game in this case.
Zulon, we've talked a little bit about actually the opportunities that the PE-backed model and structure offers to incentivize, the more junior talent. So not just the kind of the equity partners, but kind of the future pipeline of talent coming through. What do you see around that?
As Corinne mentioned, you don't have to have PE backing in order to incentivize non-partners in the business, but often the models that are, and the restructuring that occurs as a result of PE investment coming into a firm kind of lends itself quite well to putting in place kind of tax advantage employee share schemes, for example. And that can be quite a unique offer to employees, senior individuals in the business services departments of the business, and associates as well, in terms of long-term incentivization, a kind of a stake in the growth of the business going forward, which is something that they may not be offered in a traditional law firm model. So there's an opportunity to kind of widen participation in equity in a kind of PE-backed structure.
Which is quite important, because there can be a perception, rightly or wrongly, that law firm owners who are bringing in PE backing might be potentially selling off the family silver. But what I'm hearing, and that in itself deprives the next generation of opportunities. But what I'm hearing from you is actually it can open up. It might even open up more opportunities sooner than might otherwise have existed.
Absolutely. And I think that's one, in order to kind of make any professional services business, law firm succeed for the long term in this kind of PE-backed environment, they do need to have a keen eye on how they attract and retain the future generation of talent. And they can certainly use some of the tools in their armory, including share option schemes, to do that, to keep people engaged and incentivizing the future growth of the business.
I absolutely agree with those remarks. I guess I was just going to observe that the next generation of ambitious, talented people coming through our businesses, either on the legal services or the non-legal services side of the business, they've got huge financial pressures, the likes of which the sort of current generations don't really recognise. So these incentives are going to have to be in addition to competitive market salaries and bonuses, because they're going to need to get mortgages, pay off student debt, start putting money in their pensions. So I don't think that businesses can hear these comments and think to themselves, oh great, we'll be able to sort of slim down salaries and sort of top it up with share incentives. It will have to be competitive salaries and bonuses in addition to these incentives, in order, I think, to really work for the most talented people that are coming through.
Yeah, I completely agree with that, Corinne. But I think a key thing to remember is that in traditional firms, you have to wait your turn to get a stake in the equity, whereas you might have that opportunity much earlier in your career. And plus, in order to get your turn in more traditional models, you often have to have skin in the game, put capital in the business. And again, in these types of structures, it's not necessary to contribute any money up front in order to have a stake in the future kind of capital proceeds if the firm is sold going forward.
Now, can I just stop you there, because you're starting to make, we're all partnership lawyers here. You're starting to make this sound a lot more attractive than partnership. Are you telling me that the whole model, of the arrangement, of the structure, for example, in which PE-backed firms operate, will have to change from like a partnership model to a corporate model, whether it's structurally or actually and also culturally? Who's going to take that one?
I'm happy to take that one, Claire. So I don't. I think it really depends on what you're trying to achieve. I would say that usually you would expect some structural change if you're bringing on external investment, but that doesn't necessarily mean that you completely move away from the LLP or partnership structure altogether. Usually you find lots of hybrid models. So a limited company sitting above the LLP, and that can have lots of advantages. And the reason why a limited company is kind of key in the structure is it's what's familiar to external investments, especially in the PE environment. It's what they're used to investing in. They are very familiar with the structure, how it works, the liability profile of limited companies, which is slightly different to LLPs. And also the limited company has kind of much more prescriptive governance around it, and quite a very clear rules under the Companies Act, which not all those kind of prescriptive rules around governance necessarily apply to LLPs. But of course, the beauty of the LLP is it's so flexible, especially around remuneration, which is what we're talking about here. So keeping the LLPs actually helps the structure to be much flexible in kind of putting together a remuneration structure and package that works for the firm. So as I said, it really depends. And of course, what structure you put in place will be driven a lot by the tax advice as well as a regulatory kind of position. Obviously, in terms of kind of SRA regulation, you will need to become an ABS if you're bringing on an external investment from non-lawyers. And having a limited company in place would kind of lend itself to investment by PE funds, because there's a kind of long chain of ownership that you would have to kind of investigate in order to get the right approvals at the SRA regulatory level, and having those funds invest in a limited company sitting on top of the LLP can be kind of helpful in kind of structuring that regulatory kind of approval as well.
Oh, so that's interesting. So there's structural, there are potentially cultural and also regulatory benefits with having like a hybrid option of partnership and the corporate entity. Phew, thank goodness for that.
You mentioned culture, and I think culture is an important one in the kind of structure that you choose, because often firms want to retain the real benefits that people feel about a partnership culture in an LLP. Mm-hmm. And that can give, and retaining the LLP can help you retain some of that kind of partnership flavour that firms are used to and have found has worked for them over many, many years going back in the past. So that's one of the other reasons to keep an LLP within the structure.
Mm.
And I don't think a PE backer is looking to come in and rip everything up and start from scratch. They're interested in investing in these businesses because they recognise that they've got lots of assets, that they are strong, that they are likely to sort of deliver interesting results, and therefore what they're going to be looking to do is to retain all of the good stuff that they've identified in these businesses they want to invest into, but sort of build on that, to build it out, to grow it, possibly more quickly than the business would have grown without that sort of external influence and backing. So to Zulon's point about culture, if that is part of what is driving the success of the existing business prior to investment, the PE firm's not going to say, let's get rid of that. They're going to be asking, how can we supercharge this? How can we really make the most of it?
So in this new world of private equity-backed firms, particularly say law firms, how do other firms compete? They're running on the old models that, kind of the partners are all being paid out, albeit maybe on distribution basis. Yes, they've got sort of rotating finance, etc. But, there are some real sort of technological demands, inflationary increases, salary demands, your competitors circling. How do you compete, not just against that, against other sort of competitors in the market that are similarly structured, but also against the PE-backed models?
It's a great question, and it's something that we should all be thinking about all the time anyway. Whether or not we're considering PE backing, we have to think about strategically, what is it we're trying to achieve? How do we keep growing the business? How do we keep delivering that profitability? Whether it involves investment, short or long-term investment, or whether it involves making changes in terms of the type of work you're doing or the type of ways that you're doing it. But I think if we just focus on that question of sort of remuneration of partners, how do you compete? How do you make sure that you've got the most talented, the best people for your business in the business? I think you can, as we've talked about before, if you really want to simulate the type of compensation package that you will get in a firm that's PE backed, perhaps run as a company, perhaps run as an LLP, you can do that. If you run as an LLP, you can do whatever you want to achieve your compensation system. That's the beauty, as Zulon says, it's incredibly flexible. I guess the only thing I would say is, do you want to? Because I think that there's a huge range of people out there. Some people will really be well suited to the PE-backed environment, and they'll find that sort of targets driven, kind of the certainty of salary and bonus very motivating. Other people won't like it, whether that's because they've always dreamt of being a partner in a law firm, whether it's because they want the full income distribution, who knows. But there's all sorts of people out there, and therefore you need to ask yourself, before you just blindly say, oh, we must align with what other people are doing in the business, ask yourself, well, actually, what is it that keeps our partners in our business, and what is it that will draw new talented partners to our business, whether it's kind of people coming through organically or whether it's lateral hires. And ask yourself what's right for our business. And that might be competing on quite similar terms with other perhaps externally backed firms, or it might be differentiating yourself, offering something different. Maybe compensation isn't just the only thing, and we'll talk about governance in another session, I know, but the ability to control decision making, maybe influence, actually will be super important to people that have come from a PE-backed environment where they don't have any meaningful say. I mean, that's what I mean. You have to sit down and think what works for our business.
So having that clear strategic focus as to what it is you actually want to do with the business in the longer term, what it is you're trying to achieve, what environment you're trying to maintain, but maybe also looking at the best of what PE-backed firms have. So like internal efficiencies, that kind of confidence and kind of the finance lines to grow, and maybe to be bolder, more strategic vision, sort of more financial investment, a bigger vision. You can sort of, take the best of what they do, but also maybe look as well at what they're not doing well. The things where PE firms so far are not doing well, and going, how can we as a law firm actually be brilliant at that and turn it into a positive advantage and a selling point? So Zulon, do you think that another perhaps benefit of traditional partnership model firms looking at PE backed firms could be also looking at KPIs, and also will this be the opportunity for them to finally grasp the nettle and deal with underperforming partners in a way that the PE houses would force their firms to deal with underperforming partners? And do you think do you think the approach is going to change? Are the KPIs going to be different? Are they going to be tougher? Are they going to be more enforced? What do you think?
On KPIs, I don't think the core KPIs that we often see at most law firms will change that much. So, billables, origination, profitability, team contribution, I think those core elements will still remain there. What will change is the culture of performance and enforcement of those KPIs and managing underperformance. That is probably going to be at a much heightened level than the firm might be used to. But there are, of course, lots of law firms that do rigorously enforce their performance expectations of partners. But we also know lots of firms that are not necessarily, dealing with their underperforming partners adequately. So I think in a PE-backed culture, there's going to be no place to hide effectively for those underperformers, and there will be much more rigorous enforcement of the KPIs that are put in place. In terms of kind of specific KPIs that might be driven by PE, we have to remember that PE is working to a cycle. They have a business cycle of 3 to 5 years when they're going to potentially be looking for an exit. And in order to get to that exit, they will have a business plan that will envisage the firm having grown to a certain level to achieve the exit value that they based effectively their initial investment on. And of course, all of that investment value can only be achieved through growth of the business. And so we will see much closer alignment of the business strategic objectives with individual partner KPIs. And if the firm, which is likely to put in place kind of equity, share options, etc., for partners and other individuals in the firm, those equity investments are likely to be very closely linked to how well the firm is doing in terms of the business plan that private equity has in place. The culture around performance and expectations and dealing with underperformance is likely to change quite radically if it's not already a very high performing firm.
Much less forgiving. Underperformance being dealt with much more rapidly, maybe not necessarily higher targets, but just more rigorously and quickly enforced. And that's where, back to the start of our conversation, if you're not delivering as expected, for whatever reason, you might not be the good leaver. You might end up leaving, and you might not be the good leaver that you'd hoped, and you might not actually get the capital value that you originally kind of signed up for in the first place. So you kind of got to be careful about all of these. You've got to understand the strategic trajectory of the firm. You've got to understand the expectations for the firm and for you personally. And you've got to be pretty confident, I think, that you're going to be able to deliver them.
Yeah, absolutely. And as there's a link to governance, which we'll be talking about in a next kind of episode of this series. But part of that rigorous enforcement will be that, the PE firm will have individuals in place on the Remco, rigorously enforcing those KPIs against partners. But we can talk about that a bit more in the next episode. So I think the key thing to take away is that there is likely to be a very significant cultural shift around performance with an external investor.
And I think, Zulon, that's going to be an area where there's going to be scope for tension at the point at which the firm decides whether to accept external investment, whether to go with some kind of PE backer, because I think that the partners will probably fall into different cohorts. There'll be some partners that are in the nearing retirement cohort that might not necessarily be signing up for a long period. And the likelihood is that if they're not going to be in the firm at the point of the first exit, so within that sort of 3 to 5 years that Zulon mentioned earlier, then those people are going to be looking for, they'll probably have different terms and individually negotiated terms. And the likelihood is that they will be able to realise quite a lot of capital for a minimal amount of time in the business. Contrast that with people who are more junior through their careers, have got a longer trajectory left with the firm. They're going to be in the firm for a long time, and therefore they're going to be heavily reliant on the remuneration package that's going to be there year on year on year. And as Zulon says, be bound into meeting those KPIs in order to continue to be entitled to its year on year on year. So there's going to be this weird tension where different generations of partners within the firms are going to be achieving their sort of capital return at different stages of their career. And some of those people who don't achieve the capital on day one, for example, because they're more junior, they perhaps may never achieve it if they want to leave the firm before a capital event, or at a capital event, or want to leave or are asked to leave. That's the elephant in the room, isn't it, with performance management?
So look, let me just ask you this. If a firm is considering, they're in the early stages considering maybe PE investment, in the context of it, remuneration, and thinking about remuneration, are there one or two things that you can suggest that they can think about now before they've even engaged with the PE houses? What can they think about now in terms of planning and getting in a good position, so that it wouldn't be such a shock from a remuneration perspective if they do go down the PE route?
They could start with the low-hanging fruit, which is actually deal with underperformance. And they should be doing that regardless of whether they are looking for external investment or not. It's just good business hygiene, right, to make sure partners who are not performing to the level that's expected of them are being dealt with, whether that's some kind of remediation, performance improvement plan, or ultimately exiting them if necessary.
Thank
I
you.
would agree with that, Zulon, and I would add to that that people need to understand what those expectations are. You need some form of appraisal system or KPIs that are very clearly understood, and that you require partners to deliver against them on a regular basis, because then if you do get into a world where you have that more robust enforcement of those KPIs, there's a familiarity with it. There's an understanding that everybody is driving towards specific strategic goals, and everybody has to deliver their particular piece of that jigsaw in order for the growth to come. But again, Zulon, that is relevant within a PE firm or preparation for PE backing. But it's really good housekeeping. All firms should be doing that anyway. You don't want a system where you're not sort of telling the partners what the expectations are of them, or you're not expecting them to contribute. That doesn't feel like a healthy way to run any business, regardless of the structure or the backing.
Yeah, and in order to make the firm attractive to PE investment, the firm has to have a really compelling business case, right? And your remuneration system and the KPIs and the performance of your partners will factor in hugely into that business plan. So have an eye to that, and whether you do need to tweak your remuneration system, tighten up your KPIs, improve your performance management as part of that, putting together that really compelling business case.
So what I'm hearing is PE investment should be a positive strategic decision, not a reactive response to failing to deal with underperformance, having too small a profit pool, or just not having a next generation lined up. It should actually be a positive strategic choice for growth. Okay, well, thank you so much, both of you. I mean, for me, this is fascinating. I really enjoyed it. I hope if you've been watching, thank you so much for staying with us. Hope you found it interesting. If you have any questions or feedback, please do feel free to get in contact with Corinne and Zulon. They have a huge amount of experience in this area, and they would love to hear from you. Watch out for the next in this series, which will be around governance. If you've got any questions in advance, drop us a line. We'd love to hear from you. But in the meantime, thanks again and take care. Cheers. Bye.